When you apply for a loan or credit card, you need to pay attention to your interest rate. It can seriously affect how much you end up paying. For example, take these two. They both want to finance the same $1,000 oven. This gal has good credit, so the store gives her a 10% APR or annual percentage rate, which means she'll pay 10% interest on the oven per year until it's paid off. 10% on $1,000 is $100, bringing her total to $1,100 for the year. She sets up a one-year plan, pays $91.67 a month, and she's done. This guy, on the other hand, doesn't have good credit, so the store gives him a 25% APR. That's an extra $250 per year added to the oven. He can pay it off in 1 year with a monthly payment of $104.17 or 2 years with a monthly payment of $62.50. He goes with the lower payment because he thinks he's saving money, but in the end, he actually pays more. Why? Because it's a 25% interest rate per year, so he ends up paying an extra $250 on the oven the first year and an extra $250 the second year, bringing his grand total to $1,500. $1,500! That's $400 more than she paid for the same oven, and $250 more than he would have paid if he went for the one-year plan. So, what's the lesson? 1. Credit affects your interest rate, and your interest rates can seriously impact your total cost. The good news is, all lenders are required to show you the interest rate and even the total amount to repay in some cases before you're approved. So do your research first and find the best one. And 2, don't be tempted by low monthly payments. Instead, look at the interest rate, the amount you're borrowing, and how long it will take you to pay it off, because that's where you'll find the true cost of credit.